Do you honestly believe this level of growth is sustainable? Trees don't grow to the sky. I promise this isn't a video about trees. So what you're saying is that MasterCard will become a $600 trillion company? Hi, my name is Ognian, and today I want to issue a warning about a false belief many dividend growth investors have that will, in my opinion, cause a lot of trouble in their investing journey. And that is the strategy of picking ultra-low yielding companies with very high dividend growth and projecting that growth for decades, which creates a very appealing scenario. A scenario that, however, unfortunately, is most likely not going to become true. Now, the first thing you need to understand is that I am not against dividend growth investing, as I am practicing it myself. But today I will talk about a subset of the dividend growth investing strategy that I believe is delusional, and yet you see it all over the investing education space. So, what exactly are people hoping for? Let's say that you want to pick a great company with rapid growth that has a tiny dividend yield that grows at a large CAGR. This stands for compounded annual growth rate. So the company yields 0.5% and has a CAGR of 15%. That means that when you invest $1,000 in it, you will get only $5 per year. Boring. Okay, but due to the compounding effect on year 10th, you will get 2.02% yield on the same $1,000, also known as yield on cost, which is $20.20. Still boring. Now, on the year 20, however, things get exciting. Now you're getting 8.18% yield, which equals $81.80. That's not bad, but here is when things start getting crazy. On the 30th year, you get 33.1% yield, which means you are making $331 on your initial $1,000. Now, that's a good deal. But of course, because our company isn't slowing down, on the 40th year, your yield is a monstrous 133.9%, which means now you're making $1,339 on your initial $1,000 every year. Awesome. So, if you're a responsible long-term investor, this is what you do. Right? 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 Well, not so fast. The problem here is that trees can't grow to the sky. Dude, why are you talking about trees? Well, apparently there is this German proverb that says that trees don't grow to the sky. Obviously, because at some point some people in Germany thought that they do grow to the sky. And so a proverb was created to show them it's not true. I don't know any Germans, so I won't judge. You see, there are two problems here, which I will look at separately. The first is that the bigger a company or an organism grows, the slower its growth becomes. At one point, there is only so much marketplace share you can capture and so many customers left to serve, which of course influences the dividend growth. Now, this is not 100% certainty. Obviously, if there are exceptions, let me know in the comments, but as a general rule, that's true. For example, take a look at the 10-year dividend growth rate of Microsoft, which currently only yields 0.8%. It's 11.45%. Now, the 5-year growth rate, it's 10.12%. Now, the 3-year dividend CAGR, it's 10.06%. Now, the rate for the past 12 months, it is 9.68%. Notice a trend? And what are the analyst projections for the growth rate of the dividend moving forward? 5.25% per year. Now, these are just projections. Is it possible they are not going to be correct? Of course. Maybe you're watching this 2 years from now and there is a new revenue stream that Microsoft has found and the dividend has exploded. It's possible, but I'm working with data we have right now. I will give one more example which is way more extreme. The company Broadcom, ticker symbol AVGO. Here is their 10-year dividend growth rate, a ridiculously high 37.71%. Now, before you get excited and project that over the next decade, let's see what happens with the advancement of time. The 5-year CAGR of the dividend goes down to 23.34%. The 3-year growth goes down to 13.02%. The last 12 months, the dividend has grown with 12.20%. And the projection for the next 3 years is 5.82%. Now, does that mean that Microsoft and Broadcom are not worth owning? Of course not. This is not at all what I'm saying. They are one of the best companies out there. But this is not the point of the video. The point of the video is that the growth rate of the dividend of both for the smaller, most recent time periods, like the last 12 months or 3 years, does not equal the 10-year period, and the trajectory is for a decreasing of the CAGR, not the other way around. This is completely normal, and I will illustrate why with the following example, using another so-called darling of the ultra-low yield, high growth, dividend growth investing style, MasterCard. At the time of recording this video, the company has a 0.55% dividend yield and 10-year dividend growth rate of 28.44%, which is extremely high. I will not discuss here the other strengths of the company, as I am not judging whether it is a good company to own, only using it to illustrate the point of the video. Now, MasterCard is a favorite amongst dividend growth investors. Why? Well, if you search on YouTube or social media, you will see a lot of gurus making superficial videos inputting the 10-year dividend growth rate into a calculator and telling you how, yes, the yield is low right now, but oh boy, see what it will be in 30 years. If we calculate how much your yield on cost will be, remember, that's the dividend percentage you are getting based on your initial money you put in. We can see that it will be 1003% in 30 years. Does that sound any alarm? If it does, then rightfully so. But I want to dive into this argument deeper and show you why actually the trees can't grow to the sky. I actually love forests. This is why I can't stop talking about trees, not because I'm interested in investing. So in order for a company to grow its dividend, the only healthy way of doing it is through growing their earnings. Otherwise, it either has to take on debt or increase the payout ratio, both of which are not desirable. If MasterCard is the great company that it is and it remains so, we have to assume it will grow its earnings in line with the growth of the dividend, so that it continues to be as healthy as investors are hoping for. So let's play this out. The current net income of the company for the last 12 months is $10 billion and $230 million. The reason it shows 10,230 is because all these numbers in the statements are in millions of dollars. So we have to multiply that by 1 million. Okay, so let's do the same math we did with the dividend and extrapolate the 28.44% yearly growth to the earnings. In 30 years, the yearly earnings of MasterCard are going to be 18,658. What the hell is that number? I honestly can't read that thing. So let's ask my AI assistant to read it for me. All right, so the yearly earnings of MasterCard in 30 years will be $18 trillion and $658 billion. I will leave to you to decide if that's possible. In order to further illustrate my point, let's see how much the company will have to be worth in that case. For that purpose, I will use something called the PE ratio. What is the PE ratio? It stands for price to earnings ratio, and is a metric used by investors to calculate whether a company is overvalued or undervalued. It is basically a number that is the result of dividing the current market capitalization of the company by its earnings. The higher the PE ratio is, the more investors value the company and its earnings potential. For example, if a company makes $10 a year and the price of the whole company is $100, then we divide 100 by 10 and we get price to earnings ratio of 10. And then if the ratio is kept the same and the company starts making $20 in net income per year, or earnings that are used interchangeably, then the price of it should go to 200, because 20 times the 10 multiplier equals 200. Okay, so let's apply that to MasterCard. The current price to earnings ratio of the company is 34.06. So let's see how much the company will be worth, or what market capitalization it will have in 30 years. We multiply the 18 trillion and whatever it was number we got by 34.06, and we get, okay guys, I think these numbers are getting ridiculous. What is this? I just broke Google's calculator. Well, I hope ChatGPT is able to tell me what this number is. Let's ask. All right, $635 trillion and whatever comes after that. Yeah, right. This is how much MasterCard will be worth in 30 years if the theory of the dividend growth investors that project that dividend growth in the future is right. But of course, when they make their video clips that go viral and hype you up, they just happen to not mention that. Now, since this is investing and personal finance channel, I don't like to say that a particular financial projection is certain, because it would be A, not right for me to do so, since only God knows, and B, actually illegal. In the same way, I also try to avoid saying that something is impossible, so I won't say it today either. But I will just leave you with that. $635 trillion company is 231 times bigger than currently Apple. The biggest company in the world is. And also, the current whole world GDP, which is the market value of all goods and services produced, is $105 trillion according to the IMF projection I found on Visual Capitalist's website. Which means that MasterCard has to be 6 times larger in 30 years than the whole world GDP is right now. Yeah, right. I will leave you to judge whether that's possible or not. And sure, MasterCard has about 20% payout ratio of the dividend as a percentage of earnings right now. Let's say they have stopped reinvesting in the business and increased it to 90%. And, okay, let's say they have stopped buying back shares and poured that money into the dividend payouts. It still has to be over $100 trillion worth. Highly unlikely. I hope with that example I was able to show you why such projections are insane and can be dangerous to make. If you're getting value from this video, please like it. It helps the channel a lot. And also, in order to not rely on the algorithm for future videos, but get notified in your account, hit the subscribe button with the notification bell. That way you will control what you see. Thank you very much for doing it. Okay, up until now, I have been talking about the first problem of this style of dividend growth investing, which is that trees don't grow to the sky. See? Talking about trees again. Now I will discuss the second problem. I won't mention the word tree again for the rest of the video. Promise. See, the people who invest in ultra-low yielding, high-growth dividend stocks like to think they are investing in a very safe way, and sometimes even mock other types of dividend investors who go for higher yielding stocks. And while, yes, the companies I have mentioned are very low risk and are one of the world's best businesses, the dividend compounding thesis is full of risks. And yet, they present these companies as better and less risky investments, even though the whole growth thesis is risky to the core, which is quite ironic. We already saw how the projections are insane, but now I want to talk about something else. When investors make these projections, they are doing them for decades and decades ahead. It is the only way this thesis has time to play out. But it's interesting to me how a 4% yielding stock today is considered risky, and yet no one stops to question whether the future in 25 years for your favorite 0.5% dividend grower will play out the way you plan it. Isn't that a paradox? A lot of times these companies are also in the technology and related sectors, which are great sectors to be in, but are also very easy to disrupt. If we go with the example of MasterCard and let's add their main competitor in the payment sector, Visa, there are a million things that could happen in 30 years when your supposed projections should have played out and you finally get to enjoy your big yield on cost. For example, government and central banks, CBDCs, which stands for central bank digital currencies, could have taken over the payments networks. I hope for the sake of our freedom it doesn't happen, but it's still possible. What is Visa's business model then? It's gone. Or perhaps we go the other way and we use blockchain in a certain way. Do Visa and MasterCard go away? I don't know. Perhaps they integrate themselves in the new environment, but now can't grow as much. Or perhaps they are wiped out. We have certainly seen this happen to companies in the past when technology and the landscape shifts. Blockbuster and Netflix, anyone? I honestly don't know. Nobody knows. Heck, 40 years ago, we did not have internet, and now we have AI. Do you honestly have any idea what the world will look like in 30 years? I certainly don't. And so, to place all your bets on the hope that in 3 decades you will finally be able to get that big dividend yield sounds like a dangerous way to plan your financial future to me. Okay, enough with the problems. let's talk about solutions. First thing I want to say is that it's totally fine to invest in such companies. A lot of them are great businesses, but you have to have other reasons like capital appreciation, lower but more secure dividend yield because of superior business model, etc., etc. It's all about the reasons and the expectations you go into these investments with. At least this is the way I like to look at things. For example, in my investing education program, the Dividend method, I like to equip people with the knowledge and tools they need in order to make the right decisions for themselves. If your only goal is the dividends you will get eventually in decades, I am not convinced that the ultra low yielding dividend growth investing strategy is the best, but there are plenty of other reasons to invest in such companies. Okay, so if the dividends are your main goal, what is a better strategy? In my opinion, it is far better to put bigger part of your portfolio in companies that still have plenty of growth ahead of them, but at least have a decent amount of current yield so that you get growth, but you start from a higher point. If you would like to see my current most favorite 4 stocks I'm investing in for the current environment that we are in right now, then go to the description, click the link, and I will send them to your email address for free. The report will be up to date regardless of when you watch the video because I am constantly updating it. Okay, so why did I say that it's better, in my opinion, to have a higher starting point for the yield? Because it takes many years, even decades, for a, let's say, 0.4% yield to catch up to a current yield of only, let's say, 2.5%, which a lot of great companies have. In order to illustrate that, I will take 2 stocks. One is MasterCard, which we already discussed, and the other is PepsiCo. I will compare their yields and dividend growth in the future to show you what I mean. So, as we already saw, MasterCard's current yield is 0.55%. We already established that the company can grow to the moon, so I will take the analyst projection for the dividend growth for the next few years from Seeking Alpha, which is currently 7.38%. Now, obviously these are just projections, so that video might not age very well, but we will go with that. Now, let's check what's going on with PepsiCo's dividend. PepsiCo has a 2.81% dividend yield, which is okay, but nothing spectacular. So I'm not talking about chasing high yield opportunities here. This is a topic for another video. Their projected dividend growth rate is more modest than that of MasterCard's, and it stands at 4.92% per year. Of course, their growth is going to be slower when we account for the fact that PepsiCo is over 100 years old and they sell snacks and beverages, not cutting-edge internet payment processing services. So let's do the math. Obviously, MasterCard's growth is higher, but when is its yield going to catch up with that of PepsiCo's? In order to save you time, I won't do it live here, but I have already done the calculation. It will take 71 years for that to happen if the projected growth rates remain the same. Here is MasterCard's 71st year. The yield on cost will be 86.28%. Here is PepsiCo's 71st year. The yield on cost will be 85.04%. Of course, if we go to the 80th year, things get dramatically different. This is MasterCard at year 80 with 163.7% yield on cost. And here is PepsiCo at year 80 with 131% yield on cost. So, obviously, MasterCard begins to crush PepsiCo by that time. But honestly, 80 years? Come on. No one should plan an investment in a single company based on such a time horizon. Okay, but you might say that PepsiCo is not a good example because it has a good growth trajectory, even though it is not as rapid as MasterCard's. Okay, fair enough. Let's check another boring dividend company with a higher yield and slower projected future growth. Realty Income. The company's current yield is 5.68%, and the projected dividend growth rate for the next years is a very modest 2.22%. As previously, I did the math for you. On the 48th year, the yield you are getting from MasterCard will become 16.77%, and Realty Incomes will be 16.29%. So, on the 48th year, MasterCard's tiny 0.55% yield grows enough to beat the income from Realty Income. Again, 48 years, that's a bit too much for me, especially when forecasting individual businesses' future. And again, If you want to check my current top favorite 4 companies and ETFs to which I apply all the thought process shown in the video and more, check the link in the description. Hope you found this valuable. If you have, don't forget to like and subscribe, and also let me know in the comments what do you think about the topic of the video. Do you have investments in ultra low yield, high dividend growth companies? And let me know your reasons for it. And if you don't, let me know your favorite stocks as well. I love exchanging ideas and seeing what my viewers think about the videos and what they are doing with their own investment strategies. Before you go, I recommend you to check out this video I made on income versus growth investing that should appear on your screen right now. It illustrates very well the point of future projections and forecasts, which of course are not useless and should be made, but in a careful manner, as well as the idea of paper returns and many other investment concepts that are vital for you to understand. Remember, everything I have talked about when it comes to the stocks discussed is just meant to be an example, and always have in mind that the projections might or might not come true. All the companies mentioned are not companies that you should or should not invest in. This is your decision to make. I am not your personal financial advisor, and I can't tell you what to do. Obviously, none of this is financial advice, but serves an educational and informational purpose to illustrate a specific point. I will see you in the next video.